Hello, I'm Brian Dooley. I want to thank you all for being at our seminars on captive insurance companies. The very first aspect, I tell people, you won't be saving any taxes if you don't make any money. So you're just going to have a loss. You don't need me to save your taxes there. You can do it by yourself. And so the very most important thing is the captive's going to have to make money. The client needs to go through this study. It was called a feasibility study, and of course it's always required by insurance commissioner. But at the end of the day, that's also your business plan. That's what the client's going to see. Is he going to make money? So I'm going to kind of break this talk into two parts with two subparts. One's what I call a small captive and a big captive, and then those will have domestic and foreign. So our tax law actually defines a small captive. I'm going to use that definition. And that's an insurance company whose gross premium is $1.2 million or less per year. And also economically, that's about as small as you want to have this captive make sense. Sometimes $700,000 or $800,000 okay for the first few years as the client gets his feet wet and he discovers more items that he can insure. Because generally what happens is the client has a few risks in mind. He gets his captive going, and then he talks to CPA, and he discovered he really has other risks that he'd like to insure. And over 3-4 years, the captive will mature into a viable business. So for American tax law, every domestic insurance company, it may be an LLC or form as a corporation, is taxed as a corporation under Subchapter C. Subchapter C means the tax is paid by the corporation. We've all heard of S corporations, that's under Subchapter S. So a Subchapter C corporations, the old kind of corporation that's been around since beginning of corporate taxation, has built into it the concept of double taxation. That's what we do in America with a small business or a large business. Pays tax once on its profits, pays tax again when it makes a dividend distribution or dissolves and throws off the gain to the shareholder. So for the small captive, Congress in 1986, under the concept of pro-small business, in the 80s, they were very pro-small business, as Jeff pointed out, upgraded the Risk Retention Act, a very important insurance law, and also passed special tax laws to encourage small businessmen to have captives. And Congress knew that you may want to go to the least expensive offshore jurisdiction because small businessman is watching his dollars all the time. And he doesn't want to go to an expensive place if he can get the same thing from a cheap place. So Congress actually passed a special tax law to encourage the small businessman to form the foreign captive and elect to get it treated as a domestic captive. As most of you have heard, we have really complex laws for what we call a controlled foreign corporation. They're really complex. You go to most accountants, they just don't want to do it. It's a whole educational method. But if the tax accountant, tax preparer can treat it as a domestic corporation, well, that return's pretty easy. Well, Congress was going to make it even easier for the small business. Because if you have a small captive, you can elect to only pay tax on your investment income, which means the complex part of an insurance tax return, which is a Form 1120 PC for property casualty, you can skip it all. You skip all the complex stuff. You put down your amount of your insurance income, you pay your corporate tax, that's your return. We attach to it a financial statement, which you need anyway in any jurisdiction, but that's basically your return. Congress really wanted small captives. Along comes the IRS. For whatever reason, they hate captives. We don't know why, they just hate captives. Big, small, doesn't make any difference. And so for a number of years, the IRS came out with a variety of doctrines. One was the economic family doctrine. Scared practitioners and attorneys and CPAs for a long, long time. Went to court, lost every case. I think they had to lose 3 or 4 times before they dropped that concept. Now the IRS has this concept of risk distribution, which is you need so many insureds. When you talk to the IRS, they don't know how they came up with 7. 7 is the magic number. They don't have any actual studies. They have no idea why it's 7. I think maybe they just took a dartboard. 7, that's what we do. And apparently if you use an S corporation, that's okay. If you use an LLC, it's not. Just their own logic. So it's important to recognize the IRS hates captives, and if you're going to do a captive, you're going to make them mad. And they'll probably audit you. That's just going to be the cost of doing a captive. So the client has to feel fine about that taking place. The IRS does have some guidelines. The guidelines if you have enough insurers as risk distribution, and we'll get to that more in just a moment, because that kind of comes back to the rules of a controlled foreign corporation. Assuming that your foreign or domestic captive qualifies by the IRS as an insurance company, then we look at the taxation. A small captive only pays tax on investment income. It seems to be very popular, but we have a second tax law in the United States called the Accumulated Earnings and Profit Tax, which means if you're a successful small business, we'll have to tax you twice. That's just what we do here. So the problem with the small captive making the election is that you attach to the return a financial statement, and pretty soon your reserves will disappear, because property and casualty has a risk of about 1 to 3 years, depending upon the risk. Those reserves are going to go down. You have new insurance and you get more reserves, but eventually on the financial statement, it will show the amount that is not subject to reserves. That amount is subject to the accumulated earnings and profit tax. The normal rate was 35%. So even though you get a year or two deferral by using the Section 831B election, it's only a short-term deferral. You're going to be paying tax once again on the insurance profit and twice on the investment income. A larger captive, which doesn't get the election, gets to be all the laws of insurance company. Insurance companies have great lobbyists, they have great laws. You get a deduction for reserves. But with the property and casualty insurance, those reserves will be gone in a few years. Now, as the client finds more risk and increases his risk, those reserves will go up. But eventually it's going to flatten itself out. So the large captive is going to end up paying tax twice on its profit. Once as a C corporation, once that you consume those reserves, and once again under this accumulated earnings and profit tax. So that's the bias against captives. And it's almost ironic to me that the IRS is so anti-captive, because they could actually collect more money if they would encourage captives, so they don't get double taxation. Sometimes I think the very best method is a controlled foreign corporation. And the reason is that those laws are designed to be a penalty, and so they are laws the IRS cannot dispute, because the IRS has written them pretty strictly. They're pretty much anti-taxpayer laws. But the advantage of a controlled foreign corporation is that you only pay tax once. It's kind of like an S corporation, except you cannot deduct your losses. But with a controlled foreign corporation, certain kinds of income, one of them is insurance income and the other is investment income. The net income, which means after you deduction for reserves and operating costs, is reported on the return of the shareholder. So the advantage is you'll pay tax once. There's no other tax involved. The disadvantage of a foreign corporation, being the insurance company, is there's a 4% excise tax on the amount of premiums paid to the foreign corporation. That excise tax comes from the 1930s. It's a very important excise tax. It was designed in the Great Depression to encourage foreign insurers to come to America. In the 1930s, Congress knew our tax laws were really complicated. We were in a depression. Business cannot survive without insurance. Congress is aware of that. You may not think it, but they actually know that. So they want to make life simple for the foreign insurer. So the foreign insurer, the deal was, if you don't have an office here, you don't have a place of business here, you don't file any American tax return, you do nothing. The insurer will withhold 4%, pay it to the IRS, file a return once a year, showing the IRS the amount. And that is the end of your tax obligation. So the concept of that 4% excise tax is that since there's no American tax being paid, that's your total tax obligation. If the foreign insurance company has a U.S. office, then the excise tax is not going to apply, like a domestic insurance company. The foreign insurance company will pay tax just like a C corporation. In fact, it is a C corporation. It will get its reserve deductions, or it can elect to be a small insurance company and pay tax just once on the insurance premiums. But it too will be subject to the accumulated earnings and profit tax. So as you're looking at the mathematics of it, what I work through, as I work through all the mathematics, I believe I'm better off just with a straight controlled foreign corporation. That seems to be, I like to be assured I'm paying tax just once. That's just, it's mechanical.